Listen, I need you to picture something real, not a hypothetical. A real American living room in suburban Cleveland, Ohio, on a Wednesday morning in February 2026. His name is Thomas. He is 74 years old. He was diagnosed with stage 4 pancreatic cancer 11 weeks ago. His wife Carol is sitting next to him at the kitchen table. Their daughter flew in from Denver last week and has not left. The oncologist used the phrase comfort care in the last appointment. The hospice intake coordinator is coming Thursday. Thomas and Carol did everything right for 41 years. He worked as a plant supervisor for a manufacturing company outside Cleveland from the age of 23 until he retired at 64. He contributed to the company 401k every single year. He maxed out his IRA contributions during the years the income limit allowed it. He rolled everything into a traditional IRA when he retired. The balance today is $487,000. He also paid the premium on a $500,000 whole life insurance policy for 38 years, every month without missing a payment, without cashing it out during the lean years when the furnace needed replacing and the kids needed braces and the car needed a transmission. He paid that premium because he was told it would protect Carol when he was gone. Now Thomas needs care, serious care, the kind of care that costs $12,000 to $15,000 per month. The kind of care that will consume their savings in less than 3 years if they are not careful. Their financial advisor, the man who has managed their IRA for 11 years, recommended last week that they begin taking systematic withdrawals from the traditional IRA to cover the care costs. The advisor laid out a drawdown schedule, projected the tax consequences, prepared a chart showing how long the $487,000 would last at various monthly withdrawal rates. What the advisor never mentioned, not once, not in the initial meeting, not in the follow-up call, not in the email summary, is that Thomas has $500,000 in completely tax-free money sitting in a life insurance policy he has been paying into for 38 years. Money that he can access right now while he is still alive, completely free of federal income tax without touching the IRA at all. The IRS calls it an accelerated death benefit. Thomas's insurance company calls it a living benefit. The tax code specifically excludes it from gross income under Internal Revenue Code Section 101. Publication 554. The IRS Tax Guide for Seniors states it directly. Certain amounts paid as accelerated death benefits under a life insurance contract before the insured's death are generally excluded from income if the insured is terminally or chronically ill. Thomas qualifies. He has a terminal diagnosis with a physician certification that his illness can reasonably be expected to result in death within 24 months. He owns a policy with an accelerated death benefit rider. The money is available right now, today, this week. Instead, his advisor is directing him to draw down the traditional IRA. Every dollar he withdraws from that IRA is ordinary income. At a 22% federal marginal rate plus Ohio state income tax, Thomas is paying approximately 30% of every IRA withdrawal in combined federal and state taxes. On $180,000 in withdrawals to cover 18 months of care, he will pay approximately $54,000 in taxes on money he earned and saved over 41 years of working. The $500,000 of life insurance money available to him, tax-free, will sit completely untouched. When he dies, Carol will receive the remaining life insurance death benefit tax-free. But the IRA, depleted by 18 months of care withdrawals and reduced by $54,000 in taxes, will be significantly smaller than it needed to be. $54,000 in unnecessary taxes, paid by a 74-year-old man dying of cancer, on money he earned honestly over 4 decades, because his financial advisors, the professional who was paid to manage his retirement, never mentioned the provision that has been in the Internal Revenue Code since 1996. That is the accelerated death benefits trap, and it is happening to thousands of American families right now in 2026. Welcome to the Digital Defender. I have spent weeks going through IRS publication 554 line by line to find the provisions that the financial planning industry has every financial incentive to leave undiscussed. And the accelerated death benefits exclusion is the single most egregious example I have found, because it does not just affect planning decisions made years in advance. It affects families right now, this week, in the middle of terminal illness, who are making IRA withdrawal decisions they cannot undo while tax-free money sits available in a policy they have paid into for decades. Smash the like button right now, not at the end, right now, because the algorithm in 2026 buries this kind of senior financial truth content unless real people engage with it. Every like on this video pushes it into the feed of one more family sitting at a kitchen table making IRA withdrawal decisions right now who has no idea they have a tax-free alternative. One tap from you could save someone $50,000. Hit it now, subscribe to this channel, and flip the notification bell because this is the archive. Every week I release an investigation exactly like this one. You want to be inside it. This is not financial advice. This is the masterclass on a tax-free provision buried in a government publication that the insurance and financial planning industries have allowed millions of American families to miss during the most vulnerable moments of their lives. Let me start with the exact language from IRS Publication 554 because once you see it, you will understand why the failure to disclose this is not negligence. It is a choice. The Accelerated Death Benefits section of Publication 554 states this: certain amounts paid as accelerated death benefits under a life insurance contract or viatical settlement before the insured's death are generally excluded from income if the insured is terminally or chronically ill. Excluded from income, not reduced, not partially exempt, excluded. The IRS does not count accelerated death benefit payments as gross income. They do not appear on your tax return as income. They do not count toward the combined income formula that determines Social Security taxation. They do not count toward the modified adjusted gross income that determines IRA Medicare premium surcharges. They do not push you into a higher tax bracket. The money is invisible to the IRS as long as the requirements are met. Now let me define who qualifies because the IRS definition is specific and Publication 554 is precise about it. A terminally ill person is one who has been certified by a physician as having an illness or physical condition that can reasonably be expected to result in death within 24 months from the date of the certification. The 24-month window is the key. You need a physician certification that the diagnosis meets the standard. Most terminal diagnoses of cancer, advanced heart failure, end-stage COPD, ALS, and similar conditions qualify under this definition. A chronically ill person is one who is not terminally ill but has been certified within the previous 12 months by a licensed healthcare practitioner as meeting one of two conditions. Either the person is unable to perform without substantial help at least two activities of daily living, eating, toileting, transferring, bathing, dressing, and continence for a period of 90 days or more because of a loss of functional capacity, or the person requires substantial supervision to protect themselves from threats to health and safety due to severe cognitive impairment. This chronically ill definition covers an enormous population: advanced Alzheimer's disease, severe Parkinson's, post-stroke functional impairment, advanced multiple sclerosis. Any condition that renders a senior dependent on assistance for two or more activities of daily living for 90 days or more qualifies. The publication also specifies an important distinction for chronically ill individuals. Accelerated death benefit payments to a chronically ill person that are paid on the basis of costs incurred for qualified long-term care services are fully excludable from income. Payments made on a per diem or other periodic basis without regard to costs are excludable up to a limit. What this means in practical terms is that a senior with advanced Alzheimer's who is receiving long-term custodial care, the $12,000 to $15,000 per month nursing home or memory care facility cost, may be able to access their life insurance death benefit through an accelerated benefit to pay for that care completely tax-free, as long as the payments are directly tied to the cost of the qualified care being received. Now, let me show you exactly what this is worth in real numbers, so the financial consequence is personal and specific. Take Thomas from Cleveland. Traditional IRA balance, $487,000. Life insurance death benefit, $500,000 with an accelerated death benefit rider. Terminal diagnosis qualifying for the 24-month certification. Scenario 1. What is happening now without knowledge of the provision? Thomas draws $15,000 per month from the traditional IRA to cover care costs. Federal income tax at 22%, $3,300 per month. Ohio state income tax at approximately 3.5%, $525 per month. Total monthly tax cost on IRA withdrawals, $3,825. Over an 18-month care period, that is $68,850 in combined taxes paid on IRA withdrawals. The IRA is reduced by $270,000 in withdrawals plus $68,850 in taxes, effectively $338,850 consumed from the retirement savings Carol was depending on. Additionally, the $15,000 monthly IRA withdrawal pushes Thomas's combined income well above the Social Security 85% inclusion threshold. More of his Social Security becomes taxable. His MAGE increases. Carol faces potential IRA exposure in subsequent years as a survivor. Scenario 2, using the accelerated death benefit instead. Thomas contacts his insurance company and requests an accelerated death benefit claim based on his terminal diagnosis. He provides the physician certification. The insurance company processes the claim, typically within 30 to 60 days, and begins paying the benefit. He receives $15,000 per month from the policy to cover care costs. Federal income tax on this payment is 0. State income tax, 0. Impact on Social Security taxations, 0. Impact on IRA, 0. Impact on IRA balance, 0. Over 18 months of care costs, he has paid $270,000 in care expenses, with $270,000 of tax-free insurance money. The IRA remains at $487,000 for Carol, the remaining $230,000 for Carol. Life insurance death benefit still pays out to Carol tax-free upon Thomas's death. Carol inherits both the intact IRA and the remaining death benefit. The difference between Scenario 1 and Scenario 2 is $68,850 in taxes, plus the preservation of $270,000 in IRA assets that generate income for Carol for the rest of her life. The total financial value of knowing about this provision in this one case is well over $300,000 in preserved family wealth. Thomas's financial advisor, who manages a $487,000 IRA and charges a 1% annual management fee, earns $4,870 per year from that account. If Thomas uses the accelerated death benefit to cover care costs instead of drawing down the IRA, the advisor continues earning $4,870 per year on the intact balance. If Thomas draws down the IRA as the advisor recommended, the balance drops and the advisor's annual fee drops proportionally. The financial incentive for the advisor to recommend preserving the IRA balance is obvious. The financial incentive for the advisor to recommend the accelerated death benefit is that it is simply the right thing to do for the client. Those two incentives point in the same direction in this case. And yet the advisor still recommended the IRA drawdown without mentioning the alternative. That happens when advisors do not know the provision exists. And it happens when advisors know it exists, but the conversation about a client's terminal diagnosis is too emotionally difficult to have proactively. Neither excuse protects the family from the financial consequence. Now let me talk about viatical settlements, because Publication 554 specifically includes them in the exclusion, and they represent an alternative path for seniors whose policies do not include an accelerated death benefit rider, or whose insurance companies are slow to process claims. A viatical settlement is an arrangement where a terminally ill policyholder sells their life insurance policy to a third-party company, a viatical settlement provider, in exchange for a lump sum cash payment. The amount is typically between 50 and 80% of the policy's face value, depending on the insured's life expectancy and policy terms. The viatical settlement provider then owns the policy and collects the death benefit when the insured dies. The IRS excludes viatical settlement proceeds from gross income for terminally ill individuals under the same Internal Revenue Code Section 101 provision that covers accelerated death benefits. A terminally ill senior who sells a $500,000 policy for $375,000 through a viatical settlement receives $375,000 completely tax-free. The money does not appear in gross income. It does not affect Social Security taxation. It does not trigger IRA. The viatical settlement path is worth knowing about even for seniors whose policies include accelerated death benefit riders, because in some cases the viatical settlement payout is larger than what the insurance company offers through the accelerated benefit rider. Shopping the accelerated benefit against the viatical market ensures the family maximizes the tax-free proceeds available from the policy. Stop the video for 30 seconds. Think right now about whether you know anyone who is currently receiving care for a terminal illness or a chronic condition that requires long-term custodial care. A parent in a memory care facility, a sibling in hospice, a neighbor who recently received a difficult diagnosis, a friend who is drawing down their retirement savings to pay for care. If the answer is yes, Send them this video today, not after you finish watching, today. Because the longer they draw from a taxable IRA when tax-free insurance money is available, the larger the unnecessary tax bill grows. One conversation today could preserve tens of thousands of dollars for their surviving spouse or their children. Send the video now and come back. Who built this information gap? The insurance industry built it, not through malice, but through structure. Insurance agents earn commissions when they sell new policies. They earn nothing when an existing policyholder accesses their policy through an accelerated benefit. The agent who sold Thomas his whole life policy 38 years ago is no longer in contact with Thomas. The insurance company processes accelerated benefit claims as a back-office administrative function. Nobody in the system is proactively calling Thomas to say his policy has a provision worth accessing. Nobody profits from that call. The financial planning industry compounded the problem. Financial advisors who manage IRA assets have comprehensive knowledge of IRA withdrawal rules, tax optimization strategies, Roth conversion planning, and require minimum distribution management. Most have limited knowledge of life insurance tax provisions because life insurance is not the product they manage. The accelerated death benefit provision lives at the intersection of insurance law and tax law, exactly the intersection where most professionals claim the expertise of their own domain and leave the other domain to someone else. The result is a provision has been in the tax code since 1996, 30 years, that the majority of American families facing terminal illness never know exists until it is too late to use it effectively. Mid-roll Andy break. Now the defense. 5 specific steps to determine whether accelerated death benefits are available to you or someone you love and how to access them starting this week. Step 1 is policy inventory. Pull out every life insurance policy currently in force for the household. Whole life, universal life, term life with a living benefit rider, variable life, every policy. Look at the rider section of each policy document. You are looking for language that includes the words accelerated death benefit, living benefit, terminal illness benefit, chronic illness benefit, or critical illness benefit. Any of these phrases indicates the policy may have an accessible provision. If you cannot locate the policy documents, call the insurance company directly and ask whether the policy includes an accelerated death benefit or living benefit rider. This call takes 5 minutes and costs nothing. Step 2 is physician certification. For the terminally ill exclusion, the IRS requires certification from a physician that the illness or condition can reasonably be expected to result in death within 24 months. For the chronically ill exclusion, the IRS requires certification from a licensed healthcare practitioner within the previous 12 months that the individual cannot perform 2 activities of daily living or require supervision due to cognitive impairment. Request a certification from the attending physician or specialist in writing. Keep a copy in the family estate file. This certification is the documentation that establishes the tax-free treatment of any benefit payment. Step 3 is the accelerated benefit request. Contact the insurance company's claims department, not the agent, not the general customer service line, the claims department, and ask specifically for the accelerated death benefit claim form or the living benefit claim form. Most major insurance companies have a specific department that processes these claims. Provide the physician certification with the claim form. The insurance company will review the claim, confirm the benefit amount available, and establish a payment schedule or lump sum amount depending on the policy terms. Processing time varies, but typically runs 30 to 60 days from submission of a complete claim. Step 4 is the viatical settlement comparison. Simultaneously with Step 3, contact 2 to 3 licensed viatical settlement companies and request a quote for the policy. Viatical settlement providers are licensed in most states and are regulated by state insurance departments. Compare the viatical settlements offer against the accelerated death benefit amount the insurance company is offering. Take the higher of the two. Both are tax-free for qualifying terminally ill individuals. Neither requires the approval of a financial advisor. Both generate immediately usable tax-free cash that can replace IRA withdrawals dollar for dollar. Step 5 is the IRA withdrawal suspension. The moment accelerated death benefit or viatical settlement proceeds begin flowing, suspend or reduce IRA withdrawals to the minimum required by law. For individuals over 73, the required minimum distribution must still be taken. But any distributions beyond the RMD that were being taken to cover care costs should stop the moment tax-free insurance money is available to cover those costs instead. The IRA balance preserved by this substitution continues compounding for the benefit of the surviving spouse. Every dollar of IRA balance preserved instead of withdrawn is a dollar that will not be taxed until the surviving spouse takes it. And at that point, it will be taken in a deliberate, planned, tax-optimized way rather than in an emergency that forced the withdrawal in the first place. Here is what connects everything we covered today. The IRS built a complete exclusion from gross income for accelerated death benefits paid to terminally ill and chronically ill Americans. The exclusion covers both direct accelerated benefit payments from insurance companies and viatical settlement proceeds from third-party buyers. The money is invisible to the federal income tax system. It does not affect Social Security taxation. It does not trigger IRMA A. It does not push the recipient into a higher bracket. The trap is not the tax rule. The trap is the information gap. The financial planning industry manages the IRA and directs withdrawals from it because that is the product they manage. The insurance industry processes claims when asked, but does not proactively contact policyholders to say your terminal diagnosis triggers a significant tax-free benefit you should request immediately. And in the space between those two industries, tens of thousands of American families every year pay tens of thousands of dollars in unnecessary income tax during terminal illness because nobody connected the dots for them. You now know the dots exist. You know how to connect. And if someone in your life is facing a terminal or chronic illness diagnosis right now and has a life insurance policy they have been paying into for decades, the 5 steps I just gave you are the most financially valuable information you can bring to their kitchen table this week. Before you leave, do 3 things. Smash the like button right now because it is the only mechanism that tells the algorithm to push this into the feeds of the families who need it most right now today. 1 tap. Do it. Subscribe to this channel and flip the notification bell to all because I release a new investigation exactly like this every single week. New provisions, new exclusions, new traps buried in government publications the financial industry has every incentive to leave unexplained. You want to be inside this archive and share this video with one family you know that is navigating a terminal or chronic illness right now, not later. Because tomorrow another IRA withdrawal happens that did not have to happen. Another tax bill is generated that did not have to exist. And another family pays the IRS money that belonged to their spouse and their children because nobody told them about a provision the IRS put in the tax code 30 years ago. Drop a comment below. Tell me whether you have a life insurance policy and whether anyone, your agent, your financial advisor, your CPA has ever explained the accelerated death benefit provision to you. Tell me your state. Tell me whether you or someone in your family is currently facing a qualifying diagnosis. I read every comment. Your situation becomes the warning that reaches the next family before it is too late. I will see you in the next investigation. Stay sharp. And do not let the IRS collect a single dollar of tax on money the law specifically says belongs entirely to you.